Most people who start investing in ETFs think they're doing everything right. They buy a few funds, feel good about themselves, and then the market drops 30% and they panic sell everything, locking in the worst loss of their life. I don't want that to be you. So in the next 10 minutes, you're going to understand ETFs better than most people who've been investing for years. No jargon, no fluff, just what actually matters. Number 1. What is an ETF? Think of the stock market like a buffet. Buying individual stocks is like ordering one dish and hoping it's great. An ETF, exchange traded fund, is like filling your plate with a little of everything in one go. Instead of buying Apple, Microsoft, and Amazon separately, you buy one ETF that already holds all of them, plus hundreds more. The most popular ones track indexes. VOO and SPY both track the S&P 500, which is just the 500 biggest companies in America. One purchase, instant exposure to 500 companies. But not every ETF tracks an index. Some are built around specific sectors like AI or clean energy. Others are actively managed. The ETF is the container. What's inside is what actually matters. Keep that in the back of your head as we go. Number 2, the overlap trap. Here's where most beginners get burned without ever knowing why. But before that, if you like more content like this, please make sure to hit that subscribe button to not miss out on future videos like this one. And I hope you enjoy the rest of it. They buy 3 or 4 ETFs, feel totally diversified, and then everything drops at the same time and they're confused. The reason is overlap. Say you own VOO, QQQ, and VGT. Sounds like 3 different investments, right? But look inside. VOO's top holdings are Apple, Microsoft, Nvidia, Amazon. QQQ is about 50% tech, same names. VGT is 100% tech, and Apple and Microsoft alone make up over 40% of the entire fund. You don't own 3 different things. You own Nvidia, Apple, and Microsoft 3 times with extra steps. The fix is simple. Before buying a second ETF, check what it actually holds. A free tool at ETF.com lets you compare 2 tickers and shows exactly how much they overlap. If 2 ETFs share more than 40 to 50% of their weight in the same stocks, you're concentrating, not diversifying. Overlap isn't automatically bad. If you want more tech exposure on purpose, that's a valid strategy. But know what you own, because when you don't, you think you're safe, and then one sector drops and your whole portfolio goes with it. Number 3, past performance is a trap. Still here? Good, because this one trips up even experienced investors. You see a fund with 18% average annual returns over 10 years, and you think that's the one. But here's what almost nobody says out loud. Those returns happened during one of the longest bull runs in history. That's like judging a surfer by the best wave they ever caught. The Nasdaq dropped about 78% during the dot-com crash in the early 2000s and took nearly 15 years to fully recover. ARK Innovation gained around 150% in 2020 and then lost over 75% in the 2 years after. A great recent return doesn't mean the ETF is great. It means the environment was great. The right ETF isn't the one with the best chart from last year. It's the one that matches your timeline, your goals, and your actual ability to stomach losses. Number 4, fees are quietly bleeding you. This one doesn't feel urgent until you do the math, and then it never leaves you. Every ETF charges an expense ratio, taken out automatically every year. No invoice, no reminder, just quietly gone from your returns. VOO charges 0.03%. Some thematic or actively managed ETFs charge 0.75%, 1%, even higher. According to the Investment Company Institute, the average index equity ETF expense ratio in 2025 is 0.14%, historically low. But plenty of people are still paying 5 to 10 times that without realizing it. Here's the real cost. $500 a month invested for 30 years at 8% returns. The difference between a 0.03% fee and a 1% fee is over $115,000. That's not a rounding error. That's a car, a down payment, years of retirement income, gone silently in fees that felt like nothing at the time. Simple rule: under 0.20% is great. Above 0.50%, it better have a very specific purpose. Above 1%, it almost never makes sense for a long-term investor. Number 5, more ETFs don't mean more safety. People get this wrong constantly. Owning 10 ETFs is not a diversification strategy. It's just a longer list of things to stress about. If those 10 ETFs all hold the same large-cap U.S. tech stocks, you are not protected. You're just confused. For most people starting out, 1 to 3 ETFs is genuinely enough. A broad U.S. market fund like VOO or VTI does an enormous amount of heavy lifting on its own. Want global exposure? Add an international fund like VXUS. Closer to needing the money? Add a bond fund like BND. That's a complete portfolio. Everything else is noise until you have a deliberate reason to add it. Number 6, the best ETF for them might be wrong for you. You've seen it everywhere. VOO and chill, SCHD forever, people confidently posting their portfolios online. Here's the thing. Those people have different ages, incomes, timelines, and risk tolerance than you. Copying their portfolio is like wearing someone else's prescription glasses because their vision looked clear to them. Your ETF choices should come down to 3 questions. When do you need this money? How would you actually react if your portfolio dropped 40%? And what's the goal? Growth, income, or stability? A 24-year-old with no debt investing for 40 years can handle an aggressive, all-equity portfolio. Someone 5 years from retirement probably can't. Neither is wrong. They're just different situations that need different tools. Number 7, dividends are compounding in the background. This is something most beginner videos skip completely, and it's a real missed opportunity. Many ETFs pay dividends, quarterly cash from the companies inside the fund. VOO has historically yielded around 1.2 to 1.5% annually just in dividends. That sounds small, but if you're automatically reinvesting those dividends through something called a DRIP or dividend reinvestment plan, those payouts buy you more shares, which generate more dividends, which buy more shares, compounding on autopilot without you lifting a finger. Most brokerages let you turn this on in one click. Turn it on. One thing worth knowing, though, in a taxable brokerage account, dividend distributions are a taxable event every year, even if you never sold a single share. Good to know before a surprise tax bill shows up. Number 8, automate it or you'll lose to yourself. The biggest threat to your returns isn't a market crash, it's your own brain. Should I wait for a dip? Is now a good time? What if it drops more? Those questions have cost everyday investors more money than any recession ever has. Here's the data that should settle this permanently. According to the SPIVA scorecard, the gold standard for measuring active versus passive performance, over the 20-year period ending 2024, 94.1% of actively managed domestic funds underperformed their benchmark index. Not regular people, professional fund managers with research teams, analysts, and supercomputers still lost. The strategy that actually works is dollar cost averaging. Same amount, same schedule, every single month, regardless of what the market is doing. You automatically buy more shares when prices are low and fewer when they're high. Set it up once and let it run. Boring is the point. Boring wins. Number 9, know your risks before the market tests it. Every investor thinks they're long-term until things get actually scary. Here's a real gut check. If your portfolio dropped 40% tomorrow, what would you honestly do? If the answer is sell, you're in the wrong ETFs right now. High volatility funds like QQQ or sector ETFs can drop 30 to 40% in a rough year. Broad market funds like VOO or VTI are more stable but still move. Bond ETFs like BND are lower volatility, better for protecting what you've already built. The rule is simple. Match the ETF to what you can genuinely handle, not what you hope you can handle when everything is green. Number 10, starting late is the only mistake you can't fix. Everything else in this video is fixable. Wrong ETF? Switch it. Too many funds? Simplify. High fees? Move. But time is the one thing you cannot get back. If you invest $300 a month starting at 22, you end up with around $1.4 million by retirement. Start at 32 with the exact same amount and same returns, you get about $640,000. Same discipline, same contributions, 10 years earlier means $760,000 more. You don't need a lot of money to start. Most brokerages now offer fractional shares, so you can buy into VOO with as little as $10. You don't need to understand everything first either. You learn by doing. The best time to start was 10 years ago. The second best time is right now. Here's all you need to do today. Open a free brokerage account, Fidelity, Schwab, or Vanguard. Pick one ETF, VOO or VTI if you're just starting. Turn on automatic investments and leave it alone. That's the whole strategy. The people who win with ETFs aren't the smartest investors. They're just the most consistent ones. If this video helped something finally click, drop it in the comments. I read every single one. And if you want to learn about the quantum computing ETFs that's blowing up right now, make sure you watch this video as well.